Hello from the Dukascopy TV studio in Geneva. We are talking about investment perspectives and market outlooks with Walid Moukarzel. He is head of advisory at Banque Audi in Geneva. Mr. Moukarzel, welcome to the studio.
Thank you very much for having me.
So, actually, we just start with a picture that shows that some clients actually have very low expectations on their interest rates. So there we are in a negative interest rate scenario right now. What are the perspectives in this current context?
Generally speaking, savings is excess income amassed during the working or risk-taking part of a person's career. Now, these savings are not necessarily earmarked for risk-taking, but when the central banks make deposits and risk-free assets unattractive or even penal to own, savers have to take risk. Now, this has led to what we call the search for yield. And we've seen this in the corporate bond market, in high yield, in property, and in the stock market. But unlike risk-free assets, the outcome for these investments is uncertain, especially if it turns out to be a chase for returns, which appears to be the case.
Mm-hmm. So what are the current risks, for example, by investing in the stock market?
Again, many of the risks we can mention today are already known, be it valuations, changes in monetary policy, risk of recession, deflation, spillover from a future bond sell-off, currency volatility, slower Chinese growth, or geopolitics, etc. But I think what individual investors can focus on is valuations, whether it's based on dividend yield or a price-to-earnings ratio. Unlike 2 or 3 years ago when companies were trading at a 10 to 12 times, yielding 4 to 5% dividend yields, today most of stocks are trading at about 17 to 19 times, even 20, and yielding 2 to 3% in dividend yields. Now the risk reward has obviously changed, okay? And a 1 or 2 or 3% yield today at high valuations may not be much comfort if the fundamentals of a company change and the stock price goes down 5–10% over a long period. So investors need to look at the total return now, and they need to be fairly comfortable or reasonably comfortable that the total return over that investment time span is likely to be positive. When we look at price-earnings ratio, the moment you go from the low teens to the high teens meaning companies are trading at 17, 18, or even 20 times current earnings, your ability to forecast or project is severely compromised. And you may find that over time, a few of the companies in your portfolio will beat your expectations and make current valuations look cheap in hindsight, but most likely the majority of them will not. And they're likely to disappoint and could potentially lose you money. So frankly, it just takes one recession in the next 2 or 3 years to make all these estimates look foolish.
Mm-hmm. So maybe let's also highlight the conditions for corporations. Can we talk about a positive climate and positive outlooks for corporations?
Very much so. I think for corporations, this has been the best of all worlds. They entered the crisis with strong balance sheets. Corporations outside the financial sector, of course, excluding banks, they benefited from low rates. Global growth has been more or less decent enough for them. Innovation has created new ways to reduce cost and increase productivity. They're much more astute at tax optimization. All of these and more have allowed companies to increase share buybacks, increase dividends, increase profits over time. So it is a very good environment for corporates. In every cycle you have outperformers. Obviously, Apple is one that everybody knows in this particular cycle, or at least for the last 7 or 8 years. Stock markets as a market of stocks will always be a fertile ground for finding lucrative investments. I think the outlook remains positive. The only thing I would say on a very short-term basis, there might be some risk to earnings in the upcoming earnings cycle due to start in April for US companies. But I don't think this is necessarily news for the market.
Mm-hmm. So if we invest in equities, what regions, markets, sectors do you propose?
You know, Japanese equities make a strong case. If you really want downside protection, then in Japan you have the central bank buying into equity ETFs to prop up the market, sometimes on a daily basis. You have the government pension fund increasing allocation to domestic equities, so there is a buyer helping you. You have lower valuations than in Europe and America. And you have a good possibility of corporate Japan becoming more shareholder friendly. And then again, not to forget the currency kicker. We also like strategies that seek growth companies on a regional basis in developing economies such as Asia, which for us makes sense over the long haul. However, I think right now I would also push investors towards seeking absolute return strategies going forward, as the possibility of us flying without a safety net in risk assets is not zero.
Walid Moukarzel from Bank Audi, thank you very much for being here today and sharing your knowledge with us.
Thank you very much.
And thanks for watching. Do make sure to keep clicking back on the Dukascopy TV website for latest updates and exclusive interviews. Have a great day and see you next time.